Good morning and good afternoon, everyone. Happy Easter Monday to you all. Welcome to this Business Breakdowns live call with the team here at Management Consulted. My name is Japheth Mass. I'm joined here by my colleagues Namaan, Jenny Ray, and Katie, and we're just really excited to dig into a couple of businesses here today, just to give a quick and dirty overview. And we'd really encourage you to kind of follow along, think critically through these kind of problems we're talking through, these businesses we're talking through, and help you kind of build up your business acumen. It'll help you as you're preparing for case interviews, getting familiar with these industries, these companies, et cetera. And so, really appreciate you taking some time out of your Monday morning or afternoon, wherever you're calling in from, to join us here today. And while we're talking through a couple of quick announcements here, we'd just love to see where y'all are tuning in from. So in the chat, whether you're on Zoom or YouTube or LinkedIn, etc., just type in where you're calling in from, and then one business you admire, and we might cover that business in a future business breakdown. Today, of course, we're covering two companies, Samsung and Hershey, very different companies, but just really excited to dive into these today. And if we go to the next slide, I'm just going to tee up a couple of really quick announcements here. So if you are a candidate for consulting or corporate strategy, you've likely heard about our Black Belt program and our Super Prep program. Just wanted to give a quick announcement here that our Black Belt program rate is going up in a couple of weeks. And so May 14th, that the price will go up from where it is now, 2050 to 2250. We've been adding a lot of amazing benefits to the package right now. And so in order for us to be able to continue to serve you best, this price raise is going into effect on May 14th. So the good news is you've got a couple of weeks to lock in your spot at the lowest rate possible. I'm going to quickly turn it over to my colleague, Katie Neff, to introduce herself and share how you can get in touch to get your questions answered, and book a quick info call with her if you're interested in Black Belt or Super Prep.
Thanks, Japheth. Hi, everyone. I'll keep this quick because I'm excited to hear about Hershey and Samsung. Look, as an ex-BCGer and a Black Belt alum myself, I can tell you that committing to the process of recruiting for consulting is a commitment and it requires time. So if you're interested in entering this industry, one of these programs could be a great fit for you. Black Belt offers 8 one-hour sessions with a coach at your pace based on your timeline. And Super Prep offers 20 one-hour sessions with a coach in addition to a strategy sprint, which we have coming up 17 to 23 May. As Japheth mentioned, the price for Black Belt is going up come May 14th. So the time is now to act and get the best price you possibly can. Um, on average, it takes about 8 to up to 22 cases for you to really master this interview prep process. And through that process, you're also going to help grow in your networking communication skills and figure out how you can best get your resume and cover letter in front of the people that you want to invite you for an interview. So we'll share some links in the chat. If you're not sure, book a call with me. We'll share that link as well, and I can guide you through what is the best product for you. That's all I have for now. Over to you, Japheth.
Amazing. Thank you so much, Katie. I really appreciate you popping in here just to answer questions here. And by the way, folks, if you've got a question about either these programs or something else, we're here in the chat for you today. So over the next hour, this is your chance to get your questions answered. And so please send us a message, whether private or just in the general chat, and we'll answer your questions today. Okay. Well, I'm going to turn it over to my colleague, Namaan, who's our COO, to kick us off with Samsung. Namaan, the floor is yours.
Wonderful. Thanks so much, Japheth. Thank you, Katie. Hello, everybody. Happy Monday. Again, my name is Namaan. Welcome to this live recording of Strategy Simplified. You are joining our business breakdown series. Today, we are going to be breaking down the business models of Hershey and Samsung. And one of the things I just want to do before we dive in is just tell you what you can expect in today's conversation in case you haven't joined us for one of these conversations before. And so what we do is we break down admittedly complex businesses and admittedly complex industries and try to give you bite-sized insights that will help you build your business acumen and or prepare for case interviews. So what Jenny Ray and I each do independently is we take a look at these businesses and we try to isolate the three key metrics for each business that we would be managing to or paying attention to if we were inside of that business. And so these are not the only important drivers to be paying attention to inside of these businesses, but what we are trying to demonstrate is how do you take a look at a lot of complexity, a lot of data, and quickly try to isolate some key and important drivers that will help you unlock really where the value creation happens inside of a particular business. So that's what we are doing today. And we welcome your thoughts, your comments. We welcome other things that you would look at. Engage with us in the chat, and we'll have a time for Q&A and some live discussion as well in between our conversation about Samsung or Hershey. January, before we dive into Samsung, I wanted to welcome you to this call as well and invite you to share any additional context you think would be helpful.
Look, this is a post spring break call for me. I think the most important thing that I want y'all to know is that on spring break, I was not thinking about Samsung or Hershey. In fact, I don't hold a stock position in either of these firms. We did have a training relationship with Hershey, but we don't have any access to, material non-public information for either one of these firms from a strategic perspective. So just wanted to, first of all, disclose that, but also just let you know my process and Namaan's. But mine specifically was last night before bed. I took about 20 minutes to read through the 10Ks and think about what if I were in the shoes of one of the directors of these organizations, one of the leaders of their C-suite, what I would be thinking about strategically to set up the company for the future. This is not a trading conversation. So this is not about whether it's valued correctly with the stock price or undervalued or overvalued. It's about what we would take action to do. And so through that lens, I actually dug into some of the footnotes of the 10Ks, and I'll share those specifically with you today. So we'll walk through both our thoughts that we came to, but we're also going to share a little bit about our process because we want you to be able to duplicate that when you're looking at these companies and others as well.
Love it. Well, let's dive right in. What we want to do first is we're going to start with Samsung. And what you can see on your screen right here are some key stats for Samsung. And I'll let you digest those for just a minute. What I want to do is actually walk you through how Samsung makes money. Because the first question that I ask when I look at a business is, okay, how the heck do these guys make money? And then how much does it cost them to make money? Like that, those are the simple building blocks that we start with. And so one of the things that I noticed very early on as I was looking at Samsung's documentation is how diversified the business is, especially compared to a lot of other technology companies. So there are really three major lines of business at Samsung. There's IT and mobile communications, and this includes smartphones, telecom equipment, etc. There's device solutions. This is Samsung's memory chip business, its app processors, its display business. So LCD and OLED displays for TVs, smartphones, and other devices. And then there's a consumer electronics division as well. This includes Samsung TVs, Samsung appliances, headphones, and wearables. And so there are a lot of mini businesses inside of each larger line of business, but the way that Samsung thinks about its business is in those three categories: IT and mobile communications, device solutions, and consumer electronics. And overall, Samsung has been incredibly successful. You can see for yourself here, you can go to the 10K and find these same stats on page 7. But Samsung's latest annual revenue figure was $220 billion. On that $220 billion top line, they generated a gross profit of $83 billion. That gives you some insight right there into their cost of goods sold. And then kind of filtering down to the bottom line, their operating profit was $24 billion, and they generated $24 billion in operating profit from a 267,000 base number of employees. Samsung is a South Korean company. It does not trade in the US, at least not directly. So it is listed on the Korean Stock Exchange, and you can see the ticker there if you're interested in just learning more about that side of Samsung's business. So these are the numbers. This is where we like to start before we want to start to layer in insights. And so I think the first insight for us to start to uncover and unpack is, are Samsung's costs primarily fixed or variable? And why does that matter? So January, I'll turn that over to you.
Great, thanks. So when I look at the cost of this business, you can actually keep this slide up, Namaan, because one of the hints about it, especially with a business as complex and diversified as Samsung, comes straight from the financial numbers. If they have an annual revenue of $220 billion, and of that, over about 110, 117 here is really the number. Then if we get to that number and that brings us to 200K and then another $20 billion, out of that annual revenue, you have more of it that is gross costs or variable costs than you have that's actually gross profit. And so when we see large fixed cost businesses, you'll see the opposite. You'll see between annual revenue and gross profit a pretty narrow margin. But when you have more than the gross profit reflected like this in the numbers, then you'll see that this is a variable cost business. Now we can actually go back to the products that they sell and we can identify what is it that Samsung's actually doing. And as Namaan mentioned, a couple of the key sectors before, right? The mobile phone that you may hold in your hand if you're a Android subscriber could very well be a Samsung phone. That is a variable cost business. In fact, that's one of the things that Apple recognized was powerful about their business model and why they had a completely integrated system was that they recognized that there was pricing power in the variable market. If you think about a device, right? I have at home a dishwasher that's a Samsung dishwasher, a refrigerator that's a Samsung refrigerator. Those things are also variable cost businesses. It costs something directly to make each individual unit. And there are scale advantages when you're trying to drive down the cost per unit, but still every incremental unit costs me something to produce. Even Samsung's kind of more complicated divisions, which are components, sensors, switchboards, other pieces of their functional technology that they also provide. Every single one of those, again, will have some embedded software, but really it's the hardware. So Samsung is largely a hardware business with a software support system. And because of that, we can identify it as a variable cost business. And what does that mean when we think about the overall kind of industry and the overall keys? It means that they're going to manage really differently than if the business was a fixed cost business. Namaan, anything you want to weigh in on that I missed?
No, I think it's just important for us to recognize that really Samsung has 17 businesses in one. And you have VPs and directors who are over each division going to manage it based on the cost structure that really plays out inside of that division. But overall, a majority of Samsung's business is driven by variable costs. And that really, I'm going to get into this when we talk about my metrics, has interesting implications for how you go after market share, how you price your products, how you think about focusing on hardware versus software, et cetera.
So before we go into your metrics, and I know you're going to kick off with that first, what I wanted to do is just kind of tell you a little bit about how I got smart on Samsung last night. I looked at the 10K, which I did not find super helpful at all because Samsung actually in their 10K does not break out their individual operating divisions, their regions, their products, et cetera. So I had to kind of go to other sources. And one of the places that I found that was really helpful was actually Samsung's website itself. So on their investor relations portion of the website, they have information from the income statement. And I always look first at the income statement when I'm trying to understand the business model because it's a moment in time. It's focusing on the last year's worth of performance. So it's giving us a clear snapshot, not an aggregate snapshot of how the business is operated. And it's also really talking about the flows of cash, right? Where do they come from and where do they go out? And so if you start here this is on Samsung's website exactly, you can actually see what the revenue by segment was. So when I'm looking at a business that's complicated like this, and I'm not 100% sure whether to call it a variable or a fixed cost business, I actually look at the breakdown of revenue to make sure that the largest revenue categories are reflected in that perception. And so, as we mentioned, actually the majority of these categories, their services business being the smallest one, is and the only different one. That's the only fixed cost line of business really that Samsung has. You'll see that the majority of their revenue comes from all of these other variable cost businesses. I'm going to preview my hot take here. It has something to do with services. But then when we kind of look at some of the other pieces of information, the operating profit by segment, this will drive a lot of the focus area of where you see top leaders being moved inside Samsung. A lot of their investment, their R&D dollars are also going to go to these segments. So when you look at the profit by segment, you'll actually notice, right, revenue by segment, the highest revenue segment is their mobile or their networks business. And then the operating profit by segment, their highest profitability segment in most years, excepting 2023, is their device solutions business. And so or so in that kind of digital solutions, device solutions, the focus on the hardware, you see a very different picture of where they're going to emphasize. You can also see this in terms of operating margin by segment, right? So you'll see these differences in the overall numbers, and then you have a breakdown of their regional portion of revenue. So you can see where they're selling. What are the critical lines of business? When you're thinking about something like macroeconomic issues such as tariffs right now, you can see where the impact could be for an organization like Samsung. So I find it really helpful not to look just at the big picture numbers, but to verify those by looking into each one of the segments and to understand not just what they are, but actually how important they might be to Samsung overall. Back to you, Naman.
So I went through a similar process, Jenny Ray, and I arrived at these three key metrics that I would be paying attention to if I was at Samsung. So let me just preview these for folks, and then I'll do a deeper dive into each one. So number one was global smartphone market share. Number two was the growth and competitive positioning of my semiconductor business. So that is one subsegment of that device business that you were just mentioning.
Mhm.
And then number three would be revenue growth inside the premium wearable segment. So this would be one subsegment in that consumer electronics line of business that makes up the last piece of revenue for Samsung. So let me start at the top here and go with smartphone market share. So Samsung holds the number one market share globally in smartphones ahead of Apple. And as you've already mentioned, IT and mobile communications is the greatest revenue contributor to Samsung, and the smartphone business drives a bulk of that revenue. So the first thing that I need to do is I need to make sure that I am protecting and growing my single largest revenue contributor. My focus has to be there first. And so specifically what I'd be doing is I'd be focused on doubling down on my strength. So I'd be thinking about how to maintain or grow market share in really three key markets, the US, India, and South Korea. And when I went to that investor relations page, I could start to see geographically how the business is broken down. And so tariffs are a potential threat to Samsung's US market share. So I'd be paying attention to the price elasticity of US consumers, right? Am I able to pass on some of those additional costs, or do I have to think about kind of optimizing or re-optimizing my supply chain? Um, Generally speaking, in the smartphone market, the US offers the highest margins. And so I care more about protecting share in the US than I do in a market like India, for example. And so tariffs or no tariffs, I cannot cede the US. Um, that's number one. Number two, I would also be thinking about how to expand my dominant share in India, lower margin, but much higher total addressable market. And then number three would be South Korea, where I'm a dominant player right now. I'm a homegrown company, but actually the some of the fastest global growth in the smartphone market has been happening in South Korea. So I'm already positioned well in South Korea, and I need to make sure that as I'm looking globally, I'm not losing ground or ceding share at home in my own backyard. I think one of the other reasons that I really care about smartphone market share is that it helps me drive ancillary and high margin services revenue. And so the more Samsung phones I can get in people's hands, the more revenue I'm able to drive through the Galaxy Store, the more revenue I'm able to drive through Samsung Pay. And so I I have ancillary revenue that's incredibly high margin that I'm able to extract from every additional unit that I put in the hands of a consumer. So it's not just the initial purchase, it's the ongoing revenue that I think Samsung is starting to pay more attention to that I'm very interested in as a, leader at Samsung or as someone who's breaking down a case interview problem for the company. One semi-related tidbit to smartphones that I just wanted to mention here. You mentioned the devices business, Jenny Ray, and a big part of that device business is the fact that Samsung has a foundry segment inside of that business, and that means that they produce display panels. Actually, most display panels on any smartphone in the world are manufactured by Samsung. And so that business continues to grow at a double-digit percentage annually. And I think that this insulates Samsung from some of the ebbs and flows of the larger smartphone market because it gives it exposure to what I would call the picks and shovels of the market, right? Like, you hear about the gold rush in the 1840s in California. The only people who made money in the gold rush were the people who sold the picks and the shovels, not necessarily the people who went panning for gold. And so this is the picks and shovels segment of the smartphone market. They are manufacturing display panels, not just for their own phones, but for their competitors as well. And this is a segment of the market where Samsung dominates. And so, I care about smartphone market share if I'm Samsung, but as long as the market overall continues to grow, I'm well positioned, honestly, almost either way, because of my dominance in the display panel part of that market. So smartphone market share would be the number one metric I'd be thinking about. The second metric I'd be thinking about, now I would pop over to a different part of the business now, and I'd want to think specifically about my semiconductor business. So just a little bit of a context and history lesson. Samsung's semiconductor business has exploded over the last 5 years. And there are two business segments specifically that have driven this growth. I might not say them right, but it's DRAM, DRAM, and then NAND, NAND. Like those two specific segments of semiconductors have really driven Samsung's growth in this space. Each one has experienced a 20 to 30% compound annual growth rate over the last 5 years. So it's one of the fastest growing segments of Samsung's business, and Samsung is the market leader in each of those semiconductor markets. And so what I would be doing is I'd be focused on deepening my lead in these markets through long-term partnerships and continued R&D spend. Samsung spent a staggering $29 billion in R&D last year. Like there's incredibly high CapEx that you see on Samsung's balance sheet as you take a look at the numbers. And I'd also be thinking about if I could really flex some pricing power in these markets. If I'm a market leader, if I'm experiencing 30% compound annual growth, do I have pricing power that I can leverage? And so I'd be thinking about how I could grow not just volume in this market, but also maybe grow through price increases as well. Now, there's a risk that I see here in that to maintain competitiveness and maintain a market lead in a business like semiconductors, you have to continue to spend, spend, and spend. You have to spend on R&D. You have to continue to increase your CapEx to really ensure that you have a moat around that business. And the risk there is that there are diminishing returns for every additional dollar of CapEx that you are going to invest. So that's something that I would be aware of. But right now, that wouldn't dissuade me from continuing to try and grow those businesses. Just a couple of additional points here on semiconductors. Samsung does actually manufacture AI-specific chips, so it is a competitor of NVIDIA in that specific space. This is a very small part of Samsung's business. It's $2.5 billion a year. But it's really fast-growing revenue, and AI hardware clients like hyperscalers, automakers, smartphone manufacturers are really starting to increase their investment in these AI-specific chips, and it's high-margin revenue because of the licensing and the contract manufacturing just nature of that business. And so when I think about semiconductors for Samsung, I'm not really thinking about AI-specific chips. I'm thinking of non-AI chips, but I just wanted to acknowledge that that is a small but fast-growing part of Samsung's business. Third metric that I'd be thinking about, premium wearables. Okay, so this is a subsegment of the consumer electronics part of Samsung's business. Wearables are smartwatches, headphones, items like that. The global wearable technology market is growing fast. It's projected to grow in the next 5 years at a CAGR of almost 14%. And Samsung's wearable sales are second only to Apple in revenue, even though they hold only 9% of global shipment volume. So there's a lot of room to grow in terms of shipment volume to really blow this business up. And so you're already starting to see Samsung focus on this. Early last year, their smartwatch sales volume and revenue grew by 2% and 7% year over year, respectively. Their earphone products saw a nearly 30% increase in sales revenue. And so you're starting to see momentum here, and I'd want to double down on it. Now, as Jenny Ray already mentioned, Samsung doesn't break out operating profit by like subdivision. But what I did is I just tried to connect the dots. So in fiscal year 2024, their overall operating profit margin improved to 11% from 2.5%. And this really coincided with this turbocharged growth that we saw in wearables. And so the very simple back of the napkin math that I did is that, okay, I can conclude that premium wearables are an overall margin booster for the company. And so I'd want to continue to focus on high-end wearables like the Galaxy Watch Ultra, which is their Apple Watch competitor, and aim to capture a larger share of that premium smartwatch market so that I can continue to boost margins here in fiscal year 25 and beyond. Last thing I'll say here, Jenny Ray, and I'll turn it over to you, is that Samsung acquired Harman in 2018. And when I was looking just at some of Samsung's history, this was proof of concept for me into why they should continue to expand into premium wearables. So Harman is a premium audio software and hardware company. It generates most of its revenue from headphones, and I've actually had some of their speakers in prior cars that I've had. They make great products. And so in the fourth quarter of last year, this division's operating profit surpassed the combined profits of Samsung's TV and home appliance divisions. Like, I'll just say that again, right? Just their headphone division in the fourth quarter of 2024 had greater operating profit than the TV and home appliance divisions combined. And so when I think about optimizing not just for revenue, but optimizing for profit and optimizing for profit growth, um, I think about expanding my lead in premium wearables. And there's room to grow here. If you look at one of their big competitors, Apple, like if Apple wearables, AirPods, the smartwatches were their own company, that would be a Fortune 50 business on its own. And so I think it's just another proof point for just how large the market is, what the demand looks like, and what the future growth prospects are for that market as well. Jenny Ray, over to you.
I wonder if you lose Harmons at the same rate that I lose AirPods, because I'll tell you what, the number of single AirPod packs that I've left on planes makes me a customer for life and a frequent repeat customer.
You are their favorite customer.
Yeah, exactly. When they're modeling out that business, they've got to love people like me who are leaving their AirPods all over the place. Look, I think Namaan, you took a very like COO and CMO approach. So I'm just going to zoom up one level, and this will go kind of quickly because you already really highlighted a lot of the same metrics that I would look at in the micro. And so if I were thinking about managing this business, thinking about where to deploy resources, I wouldn't even start necessarily with some of the micro level places, although I would come to the same conclusions that you did. I would just start with the high level. So the first one that I was kind of astounded by was the amount of R&D cost. You already talked about a little bit about the decline in return, and I think there's this trap sometimes that organizations like Samsung can get into about whether or not they're investing enough in R&D. It's been the lifeline of their business. It's certainly been the growth trajectory that they've gone in, and they have really not done a significant number of acquisitions. So they've grown mostly from this kind of internal R&D sector. One in a business like Samsung's, Harman is a great example of this. One of the best ways potentially to do R&D in the future is to acquire it. Right? Let other people build technology and build customer bases and build proof. So I think like the return on R&D costs, I called it the R&D cost per segment and the ROI on R&D cost per segment. For me would be one of the number one things I'd want to be looking to manage. I think you actually had a number. It was like 29 billion something. What was the number that you had for R&D cost in the whole business overall?
$29 billion last fiscal year.
Yeah, so that's like more than 10% of revenue is being spent on R&D. And I actually am not at all suggesting that they should decrease what that ratio is. I'm just suggesting that potentially there's a higher return avenue to get some of those dollars back. So R&D cost per segment. And then also, specifically the return on R&D costs per segment. If I were thinking about this as a different kind of company, like we've profiled like a pharma company or something else like that, then I would really think about that R&D cost per segment. The second one was just the percentage margin per segment, right? And so what I found pretty interesting is a lot of Samsung's fastest growing but smallest revenue businesses are their highest margin businesses. And that's a really difficult CEO place to be, right? It's a really gorgeous thing if you're sitting there with your highest revenue business that is also your highest margin business. But when you're thinking about or to focus your efforts on valuation for multiples, on profit for cash capture, you have to kind of feed your cash cows, right? Make sure that they're actually feeding back into the business, but you also need to make sure that these growth drivers are there. And so the percentage margin per segment would definitely, help me focus on priorities. Namaan already went into some detail about what some of the higher margin segments are. And then the third is the growth per product category. So, I love the fact that smartphones is where it is. But if you look at the smartphone market, there are fewer ways that you can grow in that market than there are in others, because you're basically looking at replacement rate, which we expect to extend over time, right? We expect that people will not be replacing their phones on an annual basis like they once were, but then on a biannual basis, and then on a triannual basis potentially. So when you have those slowing paces, then you have to make up for it with some price increases. There is a cliff at which customers become a little bit less interested in those kinds of price increases. So, I'm concerned about some of their core business lines in terms of the growth categories. So thinking about, the consumer as a package deal, that's one of the things that Apple's really gotten right, is that the cords, the accessories, and my disappearing iPods are all a piece of a similar package. So really thinking about Samsung growing in a per product category, but also thinking about the consumer, I think, in a more like packaged relationship way. Samsung has fewer direct relationships with consumers than a company like Apple does. That presents a risk in some of those per product category areas. So those would be my main three, right? R&D cost per segment and return on R&D. The percentage of margin per segment, which is very common, by the way, for any gross margin business or variable cost business like this one is, because that percentage margin is what you take home. It's not how many of the units you can sell as much as it is the percentage that you make on each one. And then also the growth per product category. Namaan, you want to do hot takes first? Or you want me to go?
I do. I just wanted to make one point, just based on what you said, which I think is critical, is that Samsung has like less of a direct relationship with the end consumer. And I think this was kind of one of the genius moves that Steve Jobs made, is that he zigged while everybody else was zagging. And in the early 2000s, he started to invest in brick and mortar retail. He started to invest in the Apple Store when everybody thought that the future of commerce was the internet and the internet only. And I think that really strengthened Apple's relationship with the end consumer in a way that competitors just, have not been able to replicate since then. And I just wanted to call that out because it was a counterintuitive move at the time that has proven to be a really genius move over the last 25 years. Hot takes for Samsung. It's not really that much of a hot take. It's more of a prediction. But I think you're going to start to see Samsung's CapEx continue to explode, and it's going to shrink margins. And so, like, I expect when I look at, Samsung's 10K next year, that I will see their R&D spend will have increased by another 20% to around $35 billion. Because I think what they're going to start to do is they're going to start to grow the semiconductor part of their business because they recognize that the smartphone market is maturing. And so to grow the semiconductor part of their business, to maintain their dominance in display technology, you have to continue to spend. And I think you're going to start to see an exploding R&D cost structure at Samsung, and it's going to be really interesting to see if they can protect margins as they continue to invest in these spaces. How about you, Jenny Ray?
I thought for sure you were going to say sexy Samsung stores, right? Go direct to consumer and have like a New York Times expo where you're focused
I
on.
think I think what they're going to decide to do is if they have to spend the money, they'd rather spend it in R&D.
I think so too. But that would be a hot take, Noan. That would be a hot take. My take for Samsung is that you're going to see a business reinvention in the next decade, similar to what we saw with IBM. IBM was the Samsung of the 1980s and 1990s. It was a computer that everybody had. It was a hardware business largely. They were not just IBM, but components of the IBM computers that were also in everything else that we used from a technology standpoint. And IBM reinvented itself as a services business. And I really think that even though you have these high margin, super tiny sectors of Samsung's business, they're well positioned to actually integrate the hardware and the services together. It will involve a much more robust requirement for internal consulting services, but I think you'll see Samsung in the next decade become one of the largest service providers in the world. You want to wrap up, Naman?
So that does it for Samsung, an incredibly diversified technology business. Obviously, they've been incredibly successful, and these are some of the things that we think that they're thinking about in Seoul and at Samsung headquarters as they continue to chart out a path for how they're going to thrive here in the 2020s, 2030s, and beyond.
If you get a Samsung case interview, you may actually be required in about 60 minutes to take some data, prep it for a presentation and present it in front of a panel. It's one of the most high stakes, high pressure interviews, but it's an incredible way for them to see who the future leaders of the business are before they send you through a global rotational program that will be a business education like you can't really get anywhere else. So if you do have a Samsung case interview coming up, we wanted you to feel like you had a little bit of knowledge for the business, but you'll have to go deeper to prep for that than we even did today. Should we move to Hershey?
Let's move to Hershey. And so, January, what I'm going to do is I'll pop some of the key stats for Hershey's business up on the screen. I'll let you walk through them. We'll quickly touch on the business model, and then we'll get into our key metrics.
Sounds great. If y'all have questions about Samsung or questions about Hershey, pop them in the chat as we're going through this next session, and we, kind of get toward the end of our total time together. We would love to hear from you, and we'd love to know kind of what questions you're asking and what you find interesting. An aha moment is always also helpful for us to know. So yeah, can't wait to talk about Hershey. I actually grew up about 25 miles from the Hershey HQ in Hershey, Pennsylvania, Chocolate World, Chocolate City. And it was the kind of place that I didn't recognize was such a global powerhouse of a business. In fact, the largest employer in our town at the time was Armstrong Industries, which became incredibly famous for the asbestos-lined ceiling tiles that were in, schools and all kinds of plants and business offices all over the world before they went bankrupt in kind of my teenage years. But Hershey was just there, kind of in the background. In fact, when I was growing up, I think it was probably private, but it was kind of pre its public days. And Hershey was just there making chocolates as far as I knew. And in fact, going through this process with Hershey, I discovered that the big kind of cash cow or the big driver of the Hershey portfolio is Reese's, which I never knew. I always thought it was the Hershey Kiss. I always thought it was like the little chocolate miniatures, and I never knew that Reese's was kind of what it was inside the Hershey portfolio. And I think it really dovetails with the company that Hershey is becoming today. So I'm excited to walk through some of the key stats for y'all. Namaan, I don't know if can anybody see up on your screen? Have you put it up yet? Are you waiting for the
No,
reveal?
it's up.
Can y'all see it on Namaan's screen?
Yes.
Okay, great. So I'm the only one who can't see it. Gorgeous. Awesome. So let me just walk through some of the numbers. The net sales for the year that ended in December 31st, 2024. So these are pretty recent numbers. These were just recently released. Were $11.2 billion, which was slightly up from 2023. The North America, that's kind of broken down into three divisions. So North America confectionery is about 9.1 billion of that $11.2 billion. So this is a very North America dominated business in terms of sales. Which makes sense. Most people don't go to Switzerland to buy Hershey's. So the second piece is North America salty snacks. That is kind of one of the key pieces of the business. That's the next largest, and then the smallest piece is the international piece of the business. The gross profit of the business is $5.3 billion. Namaan will kind of tie in a clue to what that means in just a minute. But that is up since 2023 based on some lower input costs. And overall, Hershey did take advantage of the coverage for CPI increases and saw 3% price increases across the board during the period of high inflation that we saw in 2024. Their operating profit was about 2.9 billion, also up. Their SG&A has remained very steady. Hershey is a very disciplined operator, and their cost of sales, going down, their revenue up slightly, but the SG&A remaining steady in that kind of environment has been one of the keys. They actually went through a pretty significant organizational transformation as well in 2023 and 2024, and that really kicked off during 2024. We saw some of the results of that change. And then the net income of $2.2 billion. At only 21,000 employees, Hershey looks like just a little league team compared to the Major League Baseball of Samsung, but still a really impressive company. This one is often featured on a lot of like Wall Street Oasis and Wall Street kind of trackers. So if you want to follow along with what happens in Hershey's business, it's kind of a great macroeconomic indicator. Hershey is at HSY on the New York Stock Exchange. Namaan, you want to wander through the business model for Hershey?
Absolutely. I think it's pretty straightforward. Hershey is a primarily variable cost-based business. And what that means is for every additional packet of Reese's that Hershey's produces, or for every additional Hershey's Kiss that Hershey's manufactures, there is an incremental cost to that additional production. So every packet of chocolate, every bag of pretzels, there is an additional cost that I incur to produce it. There's input costs like cocoa, like sugar, like flour, and other ingredients. And so it's a variable cost-based business. For every unit of production, there's an incremental cost that I must pay attention to and I must manage to. And I think that's about as straightforward as it gets. And I don't know if we need to take more time than that unpacking it because it's pretty intuitive for, I think,
There's
everybody
no
listening to this.
services side of this business.
Yeah.
Yeah, exactly. I sell chocolate and snacks in the US, and then I sell chocolate and snacks internationally, right? And so it costs me something to make every single one of them.
hmm
Well, I'll dive into a couple of the key metrics because a lot of these are going to be similar actually to Samsung's, but of course applied super differently when we think about Hershey. And then Naman, you can go into some of the deeper dive details. The three that I came up with were the gross margin by product line, the percentage of retail takeaway, which I actually didn't know. And I think it's really important when you're studying a new business to figure out what language they use. So when I was going through the footnotes of the 10K, I actually went and looked this up outside of here to try to figure out what that term actually meant. It was clearly important to them the way that they used it. But I recognized why it was important when I did a little bit of digging on that. And then the third one is the market share by category, which is really how I would think about managing, especially in light of future potential acquisition potentials. I think that Hershey does have a internal R&D and they do spend money on internal R&D. A lot of it is like what color of, new Reese's should we have? How can we like shape Reese's into something that looks different than the former Reese's, right? We just went through Easter, so it's a Reese's egg, and then it's a Reese's heart, and then like what is the Reese's kind of shape or style of the future? What does shelf stable chocolate look like in the future? But also it's looking at different kind of applications of the technology that they have. So any new invention that they're coming out with at Hershey will kind of potentially cross over that between the salty and the chocolate line. The second one is so gross margin by product line as number one, super key, right? I want to understand which of my businesses are making me the most money. What I found pretty interesting is that they're all actually fairly similar, right? They all involve similar types of inputs, and there are very few that have big price takes that are larger than others. And so the gross margin by product line is a helpful way to think about it when you're thinking about R&D costs, et cetera. But I actually would think not gross margin percentage, but actual gross margin. So I would look at Reese's differently than I would look at one of my smaller segments because I care more about the actual cash contribution from that line of business than I do the percentage margins in every situation in this business in particular, just because so many of them are very, very similar. The percentage of retail takeaway. So right, they have these were kind of things that I lifted straight off of the 10K. And in fact, I can pull it up in just a second, but it said our US candy, mint, and gum, the CMG consumer takeaway increased 0.1% and experienced a CMG market share decline of 59 basis points. So my next two were tied directly to something that they talked about inside the 10K. When I was at Bain, this is one of the places where I got the magic. When I was looking at competitors, when I was looking at organizations, like it was shocking to me how you could have two main competitors in an industry and you are one of them and you don't know what the other one is saying or doing. And so understanding exactly what Hershey is doing in terms of business intelligence is going to be really important for other chocolate players and vice versa. Hershey versus something like Frito-Lay or one of the other big players, Mondelez, right, in the snacks market is going to be really critical. So US candy, mint, and gum, the CMG consumer takeaway increased 1%. decreased market share. Our salty consumer way takeaway increased 4.2% and experienced a salty market share increase of 11 basis points. Okay, what does this tell me under the surface? First of all, candy, mint, and gum consumer takeaway declined by 59 basis points, but only increased by 0.1%. This is a very, very steady and non-growing segment of the market, right? Because a slight increase was outpaced only by slightly larger increases in other organizations, whereas the salty increased 4.2%, a pretty substantial increase. And we still experienced a salty market share increase of 11 basis points, but we weren't, eclipsing the market in that either. So we were pretty on par in salty with what the market was doing. So I'm able not just to piece together from retail takeaway, which by the way is how many people are actually walking out of the store with what I'm doing and the market share in each one of those categories. But that retail takeaway number is saying like in like for like stores, what is happening to my product? So what is the rotation of my product inside those stores? And so being able to break down their different divisions was really, really helpful and interesting for me to get a sense of where I would be managing, which is clearly in the salty space, a smaller business, a similar margin business, but a much faster growing business than the other core segments of Hershey. Namaan, over to you.
January, I came to the same conclusion, is that we need to diversify our business. 81% of our revenue comes from North America confectionery. 90% of our profit comes from North America confectionery. But all the growth is happening in the salty snacks segment. And so I do have to acknowledge here that salty snacks have a lower segment margin. So when you take a look at the numbers, the margin for salty is about 14.5%. But this is the category that is actually experiencing volume growth. When I looked at the numbers, I saw that confectionery experienced a 1.9% volume decline last year. And so you have a shrinking market versus a growing market. And so it's not like confectionery is dying tomorrow, but I need to start to diversify my business now because my primary revenue and profit drivers are in a declining market. That's not the place I want to be. And so brands like Skinny Pop, Dots Pretzels are really driving a lot of the segment growth for Hershey inside of that salty snack segment. And I'd be focused on growing that segment through specific advertising campaigns as well as shelf placement deals with retailers. So my number one thing that I'd be thinking about if I was in leadership at Hershey is how do I diversify my business away from North America confectionery? Like I have a lead there, I want to maintain it, but like I'm not really interested in doubling down on North America confectionery as much as I am in expanding into salty snacks. The second way I'd be thinking about diversifying is internationally. We just saw that around 90% of our revenue comes from North America. And what you're seeing actually internationally is that there's faster growth in both segments internationally than there is in North America. So we saw last year 3.1% volume growth for Hershey outside of North America. And that 3% volume increase was paired with an almost 5% price increase. So Hershey raises prices by 5% and still sees a 3% volume increase internationally. That's a good sign. And so are margins lower internationally than in North America? Yes. But right now, because of uh, the weakening dollar, I just read this morning actually that the dollar is at its lowest point in years. That gives me an opportunity to favorably price my products overseas and continue to capture share. And so first I'd be thinking about category diversification, then I'd be thinking about geographical diversification. That's number one. Number two, I'd be thinking about consumer price elasticity. And so there's a lot of economic concern right now. And you listen to different economists, you listen to the Fed, right? One of the things that you'll hear is, okay, is the US consumer slowing down a bit in terms of spending? And that's a critical question for Hershey to know the answer to, because most of Hershey's business right now is dependent on discretionary spending by US consumers. And you have seen, January, you alluded to this, the company increased prices by 9% in its US confectionery business to offset that 2% volume decline. And much of this increase was concentrated in core brands like Reese's. And so, how price elastic are consumers for products that really would be considered luxuries? I don't need Reese's in my pantry the way that I need bread, eggs, or milk. And so, in a slowing economy, I think what Hershey's is going to have to do is they're going to have to try to start to pull the volume lever again, as they run up against the limit of what consumers are willing to pay for chocolate and for candy. Number three, I'd really be thinking about my raw material costs and how to mitigate those. Um, the raw materials that Hershey cares about the most are cocoa and sugar. And so if you've been following the commodity markets at all, you will know that cocoa prices have reached unprecedented levels this year. They peaked at over $12,000 per metric ton. And this is primarily due to just farming conditions in West Africa. 70% of the world's cocoa comes from West Africa. Just to give you like a historical baseline for how much cocoa used to cost, historical average is $2,000 per ton. So we're at $12,000 per ton now versus a baseline of $2,000. That's a six-fold increase. And so cocoa prices have gone through the roof. Sugar prices have also risen. What does this mean? Increased production costs for Hershey. And so when you look at the cost of goods sold for Hershey, cocoa drives 20% of the cost of goods sold by itself. And so when I'm thinking about, okay, consumer price elasticity. I need to ensure that, I either keep my prices steady or I reduce my costs. That means or reduce my prices. That means I have to reduce my input costs if I cannot raise prices anymore. And my biggest input cost is cocoa. And so if I was Hershey, I'd be thinking about hedging, to lock in cocoa prices. I'd be thinking about diversifying my supply chain. I'd be thinking about cost saving initiatives like enhanced automation and operational efficiencies. I'd be thinking maybe about reformulating my products. Could I adjust my recipes to, use alternative products or to use less cocoa? Or could I diversify my portfolio so that I'm not reliant as much on chocolate products? And I think Hershey's is doing all of those things. And those are the things that I'd be paying attention to inside the business as well. The last thing that I'll just say, Jenny Ray, you made this point about Samsung, and I think it really applies to Hershey, is you can spend a lot of years with, millions and hundreds of millions of dollars in R&D to create the next, hot brand, or you can just go out and acquire it. And I think this is where a lot of Hershey's growth is going to come from in the future is inorganic growth. Bain came out with this really fascinating study earlier this year that talked about insurgent brands across categories. And the way that they defined insurgent brands is that they are small players that only account for really 2% of market share in a particular category, but they are capturing around 25% of the growth. So 2% of share, they're capturing 25% of growth. Like they are fast growing players disrupting legacy players like Hershey inside of, the chocolate business, inside of the salty snacks business. For example, Chobani picked up 20% of US yogurt market share within 10 years. You saw Dollar Shave Club and Harry's come in and disrupt Gillette, right? These were disruptor brands, insurgent brands that are much more nimble, and they are able to kind of meet consumer needs at lower costs and faster. And so it's hard for me to imagine a future in which these brands aren't going to continue to gain share. And so if I'm Hershey, I'd really be looking at acquiring some of those brands early on. And that's going to lead into my hot take that I get to in just a minute. But Jenny Ray, I'll let you respond to my metrics and share your own prediction first.
Great. So one thing that I just want to share with everybody before we go on to hot takes is the actual view of Hershey from the way that we kind of looked at this data. Because again, I think we're really interested in making sure that you have the access to go and figure this information out on your own. So Japheth popped into the chat the insight on where you can actually find this link. But this is the page for me that kind of brought it all together for Hershey. So this is the consolidated result of operations. You see net sales, cost of sales, you kind of see the annual numbers, and you look and you're kind of like, look, how would I evaluate the CEO of this business? How would I think about what's happened macroeconomically that might be driving some of these changes? You see these increases in gross margin, despite this slightly stagnating top line growth, at least in the last year. You see kind of like I mentioned earlier, right? Consistent sales and marketing information. But then this is where the magic is. It's in these notes that are in the written. And you'll see at the top, actually, I left my search up there. I just searched for salty snacks because I was interested in understanding how the salty snacks segment played into the future of everything that will be happening at Hershey. And so, moving into my hot take, and I'll turn this off the screen, but I just wanted to say that's page 27 of that overall major document. Sometimes just really like looking for targeted information is a great way to start to get smart about a business like this. Namaan, this is a non-hot take, but I just want to preface it by saying that in order to get to my hot take, I had to think about what I think Hershey is naturally going to do. And I'm confident that they will continue to invest in acquisitions in the salty snack space, potentially also in confectionery. I was watching a Mr. Beast video with my kids last night, and at the end of one of the videos, there was a guy that had won a chocolate factory, the Feastables chocolate factory. And Mr. Beast offered him 500 grand in cash for the deed of the factory. And my kids, I asked my kids, would you have taken it? And all of them said yes. And I was like, y'all are idiots. And I don't call my kids idiots very often, but I said that wasn't smart. I bet that he makes a lot off of that chocolate. Let's go figure it out. Looked it up. Mr. Beast makes $250 million off of the Feastable chocolate brand every year. Direct to consumer through an influencer. I think those are the kinds of disruptor models. Now, what does he not have? He doesn't have relationships with the very fragmented retailer space inside the US. He does not have relationships with that shelf space that is absolutely mandatory to get this to people. And snacks becoming completely direct to consumer, I just never see it happening. So that those retail relationships are a moat that Hershey has that are absolutely critical. They also have major cost advantages from a supply chain perspective because of all of those retail relationships. So I think there's a significant opportunity there. That brings me to my hot take. My hot take for Hershey is that they're going to actually also move into drinks. So I think that you're going to see not just in the future a confectionery division and a salty snacks division, but you're also going to see a beverages division. Similar category advantages. They have the ability to proliferate into retail. They have cost advantages in terms of manufacturing, super new challenges in terms of beverages versus other items, but beverage aisles in stores have continued to gain a footprint. They are very high margin businesses, fast growing categories, and lots of niche players. I think it could really be a fit for Hershey in the future.
I love that. I mean, they already sell chocolate milk, strawberry milk. You can turn those into protein shakes. You can turn those into health conscious drinks. I really like that. I got a little bit more tactical with my hot take, and I actually identified two insurgent salty snack brands that I think Hershey should go after. So number one is Catalina Crunch, and number two is Chomps. And my hot take is that you will see these become a part of the Hershey's portfolio in the next 3 years. And so Catalina Crunch. I don't know, January, if you've heard of Catalina Crunch, but they're like a keto-friendly, high-protein snack mix type of company. They offer like chickpea-based pretzels and cashews, right? And they've already surpassed $100 million in retail sales. So they have distribution into retail already. They have proof of concept, but they're still small enough to where they could benefit from Hershey scale. And I think they're still small enough to where, from a balance sheet perspective, it makes sense for Hershey financially to acquire them. So Catalina Crunch is number one, and then Chomps is number two. I'm a Chomps consumer. They offer grass-fed, sugar-free meat sticks. So, people who know me know I don't really eat lunch or breakfast. So when I get hungry during the workday, it's like, give me a beef stick and I'll keep on moving, right? And so they become one of the fastest growing snack brands in the US. They already have distribution into Costco. And so I think that Catalina Crunch and Chomps are prime acquisition targets for Hershey, and you'll see those become a part of the portfolio in the next 3 years.
I love it. So if y'all are thinking about the future of your careers, these are two both incredible places that have large internal consulting practice areas. Hershey and Samsung have similarities in terms of the way that they think about their businesses and some of the challenges and the risks that they need to manage through. But they're incredible places with the opportunity to provide internal consulting services for really dynamic businesses with significant key pieces. And we've seen people both go directly into these organizations and also go into consulting and then leave those organizations to take leadership roles because there are so many opportunities to make a difference inside orgs like this. So if you've got questions about Samsung or Hershey, we're happy to answer them. You can pop those in the chat and we'll bring them up in a future Strategy Simplified podcast. We also would just love to end today's podcast with a note to everyone that we got these ideas from you. So we are profiling Samsung and Hershey because you asked us for information about them. If there's a company that you would love for us to cover in a future Strategy Simplified, if you could please pop it in the chat or send us a message, team@managementconsulted.com. We love to hear your insights. Namaan, anything that you want to say to wrap up?
I'll just say that diving into businesses is fun. So if you don't enjoy conversations like this, or it sounds not fun to you to go dig into a 10K, then maybe consulting isn't for you. And so I think one of the values of these conversations isn't just to build your business acumen, but it's also to start to figure out where you'd be a good fit and where you wouldn't be a good fit career-wise. And so pay attention to what you enjoy as well, what you're naturally drawn to. And that I think will save you a lot of pain down the road from pursuing a career, pursuing a really intense recruiting process that might lead to a destination that you don't want to be at.
Amazing. Thanks, everyone. Have a great Monday.